market researcher for the insurance sector. Now today we're going to be discussing income protection insurance with Stuart Boseley, co-founder of Best Insurance, who are one of the UK's leading specialists in income protection insurance sector. Now, Stuart, first of all, thank you so much for coming to join us today and for talking to us in what must seem for you quite difficult times for both insurers and customers alike.
Yes, that's correct, Yasmin. It's a difficult time for everybody out there at the moment, so it gives me a good opportunity to talk about the products that we have on offer.
Now, there does appear to be rather a lot of choices for customers to make. You've got mortgage payment protection, income protection. Could you please explain the differences between these policies, Stuart?
Primarily, there's two products available, which is payment protection insurance and income protection insurance. If I start with payment protection insurance, it's a policy that's based on an insurable asset, like a mortgage, rent or loan, or it's linked to monthly outgoings that could be utility bills, gym membership or school fees, anything in that area. Okay, so income protection is based purely on the individual's monthly salary, and there's no verification of any monthly outgoings or rent, mortgage or loan.
So wouldn't then just advertising payment protection and income protection be less confusing?
The reason that insurers give you a choice is because there's lots of different insurable assets, i.e. there's a mortgage protection, you can have loan protection, or you can have monthly commitments protection. Okay, so what the insurer does is it looks at those individual insurances and those individual outgoings, and they price them accordingly. So it's easier for the market or for distributors like ourselves to actually advertise specific products, because that can mean it's cheaper or more comprehensive for the individual to purchase those policies.
Right.
Insurers want to create different distinctions between the products because that gives the individual a much more comprehensive and easy to purchase products, especially if they're purchasing online. It's easier for the insurer to distribute between the mortgage, between rent, loan payments, sure, or monthly commitments. So that's the reason why there's so much differentiators between the products that are available.
Now, you mentioned the economy can have an effect on the products available. What exactly did you mean by this?
Yes, well currently at the moment the different changes in the market. A few years back, the mortgage market was very buoyant, which meant that there was a lot of mortgage protection products sold. With the economic climate as it is, people's choices or search choices have changed, and they're more worried about redundancy rather than their mortgage protection. So people are looking more for a more comprehensive policy that covers all of their outgoings rather than just their mortgage or their loan. Right. So they'll be looking to cover a whole plethora of outgoings, like their mortgage, their utility bills, and as mentioned before, right down to mobile phone and other products.
So it's a bit like an umbrella insurance covering everything, I suppose?
That's correct.
Now, you told me the difference between income protection and payment protection. What else is high on the confusion list for customers when purchasing protection insurance? Okay,
so there's initial exclusion periods and excess periods, which does cause a lot of confusion for most customers, and that's generally where most people need some help. If I start with initial exclusion, that's the period of time that when you incept the policy, so when you purchase the policy, there's a period of time which could be 90 days or 120 days where you're not eligible to make a claim, and this is for unemployment only. It's not relevant for accident and sickness.
So what are excess periods, and why would customers choose between longer and shorter periods?
So the excess period is the time after any initial exclusion period has lapsed, that the customer can choose when they get paid from the insurer. So they make a claim, and after that claim they can choose between 30, 60, 90 days, 120 days to get paid. Right. The insurer will give the individual the choice because it's price sensitive. So if it's paid shorter, it's more expensive, and if you're willing to wait longer, then it's cheaper. And the reason the insurer gives you these choices is because some individuals have savings, they have notice periods from their employer, so that gives the customer some choices.
Brilliant, Stuart, thank you so much. That really clears things up for us. If people want to find out more, how can they contact you?
Okay, so they can go to the website, which is www.bestinsurance.co.uk, contact us by email on info@bestinsurance.co.uk or usual telephone, which is 0845 680 8218.
Brilliant, thank you very much, Stuart. So this is Yasmin Khan for Team TV.